Good day, fellow investors. So I just continue with my research on the S&P 500 that I do publicly. The rest of my research is on my research platform and you can check whatever I do. And if you want to read the research on the S&P 500 stock by stock, you just go to my course curriculum. And here the second thread is the research reference, and the S&P 500 is what I'm doing publicly, and I've done already 150 stocks of the index. Let's go back now to the stocks. I'll go through the most interesting that I found where I can maybe add some insight into your investing ideas. So a few to go through. Fiserv, it's interesting. Of course, it was a Seth Klarman holding, but he is closing his position that he purchased last year, so bought and now almost closed with a small gain, even if the stock went a little bit higher. The company provides services to the financial community. The stock did greatly over the last decade with financial services, digitalization, and everything, but it is at the P ratio of 30. It's a growth business. Maybe there will be a slowdown if there are more issues with banking, etc. It isn't really a value investment anymore, maybe, and that's also perhaps why Seth Klarman sold. Maybe something didn't materialize, a takeover or something like that. I doubt that they will double in the next 5 years, which would be required if you want to make a good return on this. The next stock I want to discuss is DUK Energy, and I remember discussing DUK Energy in a local forum when it crashed in 2003. People were analyzing it, debt issues, whatever was back then. Of course, since then it did well. But when you look at it, okay, everything looks good over the last decade, pretty stable dividend, good dividend, growing dividend, 5%, 4.5%. But if you look a little bit, there is a 70 billion debt pile. Compare it to the 70 billion market cap, you're buying something with debt in the level of the market. So when things are stable, great, and this can continue to be great for a decade or more, but when things get ugly, like in the early 2000s, things can really get ugly for these utilities. Now, discussing Target, I think we discussed it a year ago. You can click here for the link, and since then the stock is down 50%, which is a big hit. And I think here one needs to understand the long-term trend and natural long-term business forces, because investing for the long term doesn't mean buying something and holding till it recovers. Investing for the long term means understanding the business from a long term perspective. What are the long term competitive advantages? How will this business look like 10 years down the road? And that's exactly what I discussed when I discussed Target a year ago. Everyone loved it because it's growing. And if you look at the stock price now, it is reverting to pre-temporary pandemic benefits situation. And as usually Munger says about retailers, it's just a retailer. So you cannot expect the world to change there or this time is different. So you have to really be careful with these situations that are okay to cash in, but better avoid the exuberance that usually, and we'll discuss that more a little bit in future videos, the exuberance that justifies whatever stock price, no matter the market cap nor other. PayPal here if you want to read, but I'm doing stocks that crashed video tomorrow, so more on this tomorrow. Now, let's discuss here the REITs, Equinix, again, great boom here. But also don't forget the crash here, and now booming, great. But what is the advantage? 3% yield from funds from operations perspective, priced in line with the market. I really have nothing to add here except that the returns will be minimal given the dividend of 1.8%. And the risks are significantly there given whatever can happen with interest rates, debt, etc. This is something I really don't get. Colgate Palmolive price earnings ratio of 40. Okay, now maybe they will be able to revert back to the previous net income levels, but that's still a P ratio of 25. Okay, it's a consumer defensive stock, did great over the last 40 years, never had any crashes, but these PE ratios are crazy to pay for these companies. And there is more competition, natural products, whatever. They need to acquire, pay a lot of money like all other these big brands that are out there. I don't know why would people pay these levels for these companies, but that's likely pension funds and those that buy on market capitalization. Eaton, the ever-changing, reinventing company, now they are priced again P ratio of 30 because they are going into e-mobility, electrification trend that they will be the great beneficiaries of. But still, P ratio 40, you are betting on a promise about the future, and that's again not value investing. Did an analysis on railroads a while ago, and I was spot on Kansas City takeover and buyback upside. You can also check that video too. But now, if I look at rail stocks, those are a little bit down, and many of you asked me, Sven, what about rails now? What to buy? Because I was spot on that takeover. But when it comes to rail, wait for a recession. That's all I have to say. Wait for it. When it comes, doesn't matter. Maybe it will come in 2029, but still, that will be the best risk and reward situation, thus value investing. All right, CME, the derivatives and commodities exchanges, okay, they benefited from all the activity recently, but with lower commodity prices, recessions, it can be a little bit on the uglier side. However, P ratio is in line with the market, so nothing really spectacular to add there. EOG, last September I went to Zurich and listened to a presentation of EOG, and they presented themselves like the best in the business of shale, but that again depends on oil, and you can just see how the stock also fluctuates on oil prices. So again, wait for oil prices to be low again in their cycle, even if now it looks that oil prices will be high forever. That's a story that I have heard many times in the last 20 years since I have been investing. Illinois Toolworks, the stock did great, but net income didn't do much. Maybe they do buybacks. Okay, but again, a stable company priced in line with the market, so have nothing to add there. All right, Chipotle, Bill Ackman was extremely right on this one. He made a killing buying it, but now at 7 times sales, P ratio 55, could be a stable business, but you never know, and therefore it's not for me. On the Activision merger, will it go through and then you sell it to Microsoft at 93? There was this scare there, another scare when UK prohibited mergering, but we will see how it will develop. The offer is still there from Microsoft, and if it goes, you get a return of what it is, 14-15%, so likely the expectations are that it will close soon. Another very expensive company, and I expected that as I go lower on the list of S&P 500 there will be cheaper companies, but we are still P ratios at 30 for a paint company that benefited from everyone painting their homes in the last 2 years. I don't see why this is that expected. General Mills, another company in line with the market, a little bit on the cheaper side, but nothing spectacular. Stable company there. You see how it fits you. FedEx, high volatility on competition, recession fears. So there is, of course, upside if things go well, but also downside if things turn south. On the P ratio, price and dividend in line with the market, so no extra bargains there. Freeport, McMoran, whatever, when we discuss copper, I'm waiting for a recession. If it comes in 2027, then I'll buy copper again, make money, and that's it. If it doesn't come, if there is the copper super cycle that comes, good for me, I'll just keep making the money my way. Marathon Petroleum, very interesting company. Now it's trading at a P ratio of 3, but then you have to ask yourself, why isn't the dividend here 25%? Why it is just 3%? Okay, they are spending all their money on repurchases, but they are repurchasing the stock here. Look at the geniuses. And they did issue stocks here just to survive. So if you look at the number of shares going up in 2019, and then they spent billions on lowering back to where it was. That's the genius there at much higher prices. That's management. They don't care about you. They don't care about creating value. They just care about pushing their stock price high as fast as possible just to get their management bonus and compensations. Crown Castle, something went wrong recently with the stock price, perhaps interest rates, and the sprint lease cancellations for the towers. But if that stabilizes and they continue growing at 7-8% per year, then it will be a good return there. But again, there is always the risk of technology competition. Who knows? But from a certain perspective in the S&P 500, from the first 150, we made some money on Amazon, as we discussed a few days ago. This is one of the better ones. You get a nice dividend. Payments, lease payments are there for revenue, investment grade balance sheet. So very, very interesting. Of course, not for me. I'm looking for better, but for a very large portfolio that wants to accumulate these businesses at cheaper than fair prices, then this is an interesting one. Moody, P ratio 45 now. Everyone forgot that they were the reason of the financial crisis. Okay, this again beats me. Very interesting company, Roper Technologies, but then again, wait for recessions for these industrials. Even if they have high margins, great business, growing steadily. However, if you look, great business, great PE ratio, everything looks great, but the dividend yield is very low. And then you ask yourself, why is the dividend very low? I'll show you, because this acquisition spending that is higher than the net income, this is not a cost. This is like just transferring cash to assets and not a cost, but it is a cash outflow. So they are growing, everything looks great, the stock looks great, but if you look at it from a real value creation perspective, they are not printing cash, which is always one of the concerns that you might want to recheck and check before investing in something. Now, a very interesting franchise business model, nothing wrong with it, cheaper compared to whatever we looked now, and the P ratio of 20, of course, I would love it at a P ratio of 10 or 8, but even in bad times, and those were very smart that bought it here, because even in 2020, Marriott didn't lose much money, accounting wise, about 200 million when every hotel was closed because of their franchise business. And that's a very interesting, compared to the rest, at a P ratio of 20 is among the cheapest ones. I don't get the craze about Estée Lauder, likely a hot stock pumped, and now it is returning to where it should be. P ratio of 20, so another 60% down. Good luck, guys. That's it. Check my research platform. Check other stocks. 150 have been done. Thanks for watching. See you tomorrow with 4 more businesses.